price would be somewhere over $200 in silver. It can drop further, which it tends to do when we start to see silver outpace gold and the ratio drops. It tends to overcorrect. I actually think that it could go down to somewhere around 40. We can see a fair bit of volatility continue for at least the next several months. Give or take, I think we could see silver to continue to move in around the $70 to $80, $85 range. So China not only consumes a lot of silver, 60 to 70% of silver refining globally. A lot of silver has to make its way through China. I think that's one of the reasons that the US, having added silver to its critical minerals list, silver is very particular. Only about 25 to 30% of silver comes from primary silver mines. The rest comes from mining other metals like copper, gold, lead, or zinc. Higher demand for silver does not translate automatically into higher supply. Silver gets thrown back to the market to help boost supply, but someone needs to deal with it. The industrial consumers are not going to buy silver coins. They're going to buy silver in different forms that suit them for manufacturing purposes. You need to know that they're getting the product in the right form, right purity.
A lot of people are we're calling tops in silver, selling at around 100 or so, and looking for further downside in silver. I think one of the things that is true is a lot of people are saying that silver isn't cheap right now. Obviously, back when it was 20, it was a bargain. There was this huge silver story, all the industrial fundamentals, it's money, right, and all of that. Now that we've seen this huge run, what should people be thinking of the silver market? Has anything changed in your view with regard to how cheap silver is relative to its underlying fundamentals?
So that's a good point, and that's a great question and a great way to ask it, because the fundamentals, I believe, have not changed in the least bit. They've only continued to be more compelling. It is clearly not as cheap as it was, but I do believe that it is still relatively cheap. And that is based on, different indicators, things like the gold-silver ratio. It has dropped significantly.
When price triples, people assume value disappears. But ratios tell a different story. Peter Krauth notes early here that fundamentals haven't deteriorated, and the gold-silver ratio remains historically elevated despite its recent drop from extreme levels above 80 toward more normalized ranges. In past cycles, when that ratio compresses below 60, silver often accelerates, not collapses. The real question isn't, is it cheap like $20, but is it cheap relative to gold, deficits, and industrial demand? Peter Krauth hints that valuation is relative, not nostalgic. And what he implies next reframes the entire inflation argument.
It can drop further, which it tends to do when we start to see silver outpace gold and the ratio drops. It tends to overcorrect. I actually think that it could go down to somewhere around 40. So there's that. And we've got things like the inflation adjusted price for silver. If you look back to that peak, we've nearly, when silver reached $110, $120 recently, I think we essentially matched the inflation adjusted high of 2011, but the 1980 high is much higher. If you go with sort of official inflation numbers, it would be around 150 or so, perhaps 160. And if you look at more, I think, realistic inflation-adjusted numbers, that 1980 price would be somewhere over $200 in silver. So I think that we're well on our path eventually to those kinds of levels. I do think that we're going to relatively easily, eventually, perhaps this year, take out 100, and that might start to become a new floor for silver.
Headlines celebrate new highs, but inflation math quietly changes the target. Peter Krauth highlights that a gold-silver ratio of 40 would imply aggressive outperformance, levels seen during powerful monetary stress cycles like 2011. Adjusted for CPI, the 1980 spike translates closer to $150 to $200, meaning today's triple-digit prints may not be extreme at all. The danger for investors is assuming nominal highs equal cycle tops. History says otherwise. Peter Krauth is effectively arguing that $100 could become structural support, not resistance, and what comes next shifts from price charts to the real driver, debt.
But like I said, none of the fundamentals have changed. If you just look at the US, for example, $39 trillion in debt. The annual deficit is 1.8 trillion. That's 4.5% of the GDP. You're looking at over $9 trillion of debt is maturing this year. Last year, and then this year you're looking at $9 to $10 trillion more of debt. So this is something that we call the maturity wall, and the problem is the amount of borrowing that took place during short-term borrowing that took place during the pandemic. And that was very short-sighted in the sense that that borrowing was at very low rates. And so now, because it was short-term bonds, they are coming due sooner. And now we're at much higher rates. I think that's one of the big reasons that we see the Fed with or without, intervention, so to speak, the Fed sort of pretty intent on trying to keep rates low and lower them because they know that it's an impossibility. I mean, the deficits will just continue to balloon.
The real volatility isn't in silver. It's in $39 trillion of federal debt rolling over at higher rates. Peter Krauth connects the maturity wall to a refinancing squeeze, with nearly $9 to $10 trillion resetting into a rate environment far above pandemic lows. Even a 1% increase on that stack means tens of billions in added interest expense annually. That pressure limits how tight the Fed can stay beyond meetings like September's rate decisions. Peter Krauth is pointing to structural monetary accommodation, not short-term stimulus. And the next layer explains why that matters for savers.
So, lower rates are here, and they're here in the face of high and rising inflation. So that kind of ties back to what I was saying earlier. The market realizes that the Fed has this dilemma, and so rates will be low, stay low, and we might even look towards what we call yield curve control, which is what I would term the Fed's I guess you could call it triple mandate. We talk about a dual mandate, but really it has a triple mandate, and that is to moderate and keep long-term rates low. It doesn't do it often, but in situations like this, I think we should expect that. Again, another way to term it is yield curve control, and so they don't want the short-term end of maturities to be very, very low, and the curve to be very high on the longer term end. They like to keep long-term bonds lower. And so that's not great for savers, obviously, but it suits Treasury that has borrowed so much.
When inflation runs hot and rates stay low, that's not policy confusion. It's debt management. Peter Krauth suggests yield curve control could emerge quietly, similar to Japan's playbook, capping long-term yields to protect Treasury financing costs. If 10-year yields are artificially restrained while inflation stays elevated, real rates turn negative, historically bullish for hard assets. Savers lose purchasing power, while leveraged governments gain breathing room. Peter Krauth is hinting that monetary policy may prioritize solvency over price stability. And that shift carries long-term consequences most portfolios aren't positioned for.
So all of these things point to much higher precious metals prices. So, I think that investors should look, if they haven't participated already, if they bought at highs, I would certainly hold on. But I think that it's still going to look, if we look back a year or even a couple of years from now, these prices are still going to look pretty cheap.
We definitely have seen volatility recently, ups and downs. It seems to have stabilized over the last couple days. We're not seeing, $10 up and down days over the last couple trading days, but that's what we had been seeing in that huge flush out when we saw silver smash down like $40 in a day. I think that makes people a bit cautious of jumping in at the moment. Do you see this volatility continuing for much longer?
So I do think we're going to see, that's a bit of a hallmark after you get big run-ups like this. You do see a period of volatility that once the correction starts, so I do think we can see a fair bit of volatility continue for at least the next several months.
The real test of conviction isn't the rally. it's surviving the $40 drawdown days. As Peter Krauth suggests early here, volatility after parabolic moves is normal, not fatal, and silver's historical annualized volatility often exceeds 30 to 40%. That kind of swing forces weak hands out, even when fundamentals stay intact. Long-term investors should ask whether their allocation size matches their risk tolerance, especially after triple-digit prints. Peter Krauth is signaling patience, not panic. Corrections are digestion phases, and the range he outlines next becomes crucial for disciplined entry points.
But I personally would expect to see volatility within a certain range. So, give or take, I think we could see silver to continue to move in around the $70 to $80, $85 range. And so anything I feel on the lower end of that range, or perhaps even slightly below, makes for an excellent buy level. If somebody does not already own, I think that it makes sense to accumulate somewhere within that range as well. So yes, I think volatility is going to be here for a while, and investors can use that to their advantage. So, but yes, expect that to be around.
Now, as for platinum and gold as well, those have had a bit of a pullback here. Gold's still above $5,000 an ounce. Platinum's above $2,000. What is your outlook for them? Are you as bullish on those two metals as silver?
I am. I think that there's still, I believe there's more sort of leverage and upside from silver, but I think both of those metals should continue to do really, really well. I don't follow platinum nearly as much as I do gold, but depending on who you ask, it can be considered money, I suppose, a bit of a monetary metal. It certainly is used in jewelry and some other applications, but as a group, I think that these are precious metals that are expected very much to move higher for all the same drivers that we've been talking about.
Consolidation between $70 and $85 may feel boring, but ranges build foundations. Peter Krauth points out the structured volatility creates tactical accumulation zones, not random chaos. When gold holds above $5,000 and platinum above $2,000, relative strength suggests capital rotation within the metals complex rather than exit flows. Historically, multi-month bases after breakouts often precede secondary legs higher, especially when macro liquidity remains supportive. Peter Krauth is effectively mapping a trading corridor inside a secular uptrend. The geopolitical angle he raises next adds a supply dimension few equity analysts model properly.
I'll be honest, I don't really follow what is happening too much on the futures side. What I will say to your first point, which is about China and its consumption and how it's sort of handling its approach to silver for itself. It has sort of, I guess you could call it, tightened up to some extent. Its silver export rules. Some of what I have read suggests that hasn't changed things too much, at least initially. But one thing that really is interesting to consider is that China not only consumes a lot of silver, especially for something like solar panels, which it controls about 80 to 90% of global production. It also controls 60 to 70% of silver refining globally. So a lot of silver has to make its way through China before it gets exported. And if it decides that it wants to limit or restrict silver exports, then that could be problematic for a lot of other countries that perhaps need to buy silver that is refined in China.
When one country controls up to 70% of refining, that's leverage, not coincidence. Peter Krauth highlights China's dominance in both solar manufacturing and refining, creating a bottleneck risk Western markets barely price in. Even modest export tightening can disrupt supply chains, similar to rare earth restrictions seen in past trade disputes. Investors focused only on COMEX futures miss the geopolitical layer shaping physical availability. Peter Krauth is implying that supply risk isn't theoretical, it's strategic. The policy response from Washington adds another accelerant to this story.
And I think that's one of the reasons that we're seeing things like the U.S. having added silver to its critical minerals list. The U.S. planning a $2.5 billion strategic minerals reserve. Trump now telling his trade officials to explore price floors potentially for the 41 critical minerals on that list. So, it's just getting more bullish, frankly, if you look at some of the events and characteristics that are shaping this market. It's just everything's pointing to basically higher and potentially tighter markets. Something people need to consider. We've talked about this before. Is that silver is very particular. Only about 25 to 30% of silver comes from what we would call primary silver mines. The rest comes from mining other metals like copper, gold, lead, or zinc. Even at $80 or $100 silver, those gold and copper miners have little interest to try to, they're going to say, well, okay, that's great. I'm getting more for the silver that I produce, but it's a byproduct for me.
When governments discuss price floors, markets are no longer free. Peter Krauth notes silver's addition to the US critical minerals list and a proposed $2.5 billion reserve. That's policy-driven demand layered on top of industrial use. With only 25 to 30% of supply coming from primary mines, higher prices don't instantly unlock new output. Byproduct miners respond to copper economics, not silver spikes. Peter Krauth is pointing to structural, inelastic supply meeting strategic demand. The next implication is how small this market really is relative to gold.
I'm happy to accept the higher price, but I'm certainly not going to change my mine plan to try to produce more silver. So, higher demand for silver does not translate automatically into higher supply, and that those are the reasons, and so that kind of exacerbates the shortages. So there's a lot of things at play here that help to shape the silver market.
There certainly have been interesting dynamics in the retail space and the whole on the wholesale side. And one of the things that is interesting is there's this structural silver deficit that we've talked about so much, but at the same time, as the price has been rising, so much scrap silver has been flooding the markets that refiners are backed up. A lot of the times, they're not even accepting less than 999 silver. Your take on that phenomena, where it seems like there's so much need for silver industrially, that there's this deficit, but at the same time, because it's not the right type of silver, refiners aren't even accepting some.
The real story here is that price alone cannot fix a supply chain bottleneck. As Peter Krauth points out, higher prices don't instantly create new mine output because silver production cycles take 7 to 10 years from discovery to operation. Meanwhile, refiners rejecting sub-999 scrap shows the shortage is about industrial-grade metal, not retail bullion. This mismatch explains why deficits can exist even when scrap supply rises sharply. Investors should recognize that supply elasticity in silver remains extremely low compared to demand growth from electronics and solar manufacturing. Peter Krauth suggests this refining bottleneck may matter more than investors realize next.
Yeah, so that's a great point, and that's true. And so, one of the things that one of the arguments that there has always been about if silver markets get really tight is that there's a lot of silver that's owned privately, and if the silver price gets high enough, that these people will sell the silver back to the market. So one of my sort of arguments about that was that the price needed to be significantly higher than when we were talking about that a year or 2 years ago when it was $20 or $30. I was saying it needs to be, in the $70, $80 range, not in the $40, $50 range. And so, at these prices, these much higher prices recently, we've started to see that. In fact, until until we got to maybe 100 or so, the feedback I was getting from bullion dealers was that they were doing more buying than they were doing selling. So some people were cashing in their silver. But like you said, at the same time, the refiners, because they have, the luxury to be able to choose, and so many people are trying to sell them their silver, they can accept the best silver that is the most profitable for them to deal with.
Markets assume private silver holders would rush to sell long before prices reached triple digits. Peter Krauth highlights that meaningful recycling didn't accelerate until silver moved from the $20 to $30 range towards $70 or $100, showing investor psychology matters as much as price levels. Even then, bullion dealers reported net buying activity, suggesting strong long-term conviction among holders. Refiners cherry-picking high-purity supply reinforces how selective liquidity becomes during commodity stress cycles. For investors, this means recycled supply may cushion price spikes, but won't fully resolve structural shortages. Peter Krauth believes investor behavior during price surges will shape the next phase of volatility.
So basically, these restrictions are limited on their capacity, really, is what it comes down to. So it's all fine to say that, all out of this silver gets thrown back to the market to help boost supply, but someone needs to deal with it. The industrial consumers are not going to buy silver coins. They're going to buy silver in different forms that suit them for their manufacturing purposes. And so they will buy that from refiners, and they need to know that they're getting the product in the right form and in the right purity. So there are bottlenecks. And so that absolutely affects things as well. And so even as I say, if silver comes back to market in a big way at these higher prices, that doesn't necessarily translate into immediately higher silver supply. And so because it doesn't, it means that, that again continues to help to support prices. So these are all very important factors to consider. It's a small market. People need to realize that. A few months ago when I looked at the numbers, the entire silver mining market cap, so all publicly traded silver miners, including juniors, etc., was about $50 billion.
This is where the just recycle more silver argument quietly falls apart. Peter Krauth explains that industrial buyers need refined inputs, not coins or jewelry, meaning refinery throughput, not scrap availability, controls real supply. With total publicly traded silver miners valued near $50 billion, the sector is smaller than many single S&P 500 companies. That tiny scale makes supply shocks more likely and price reactions more violent than most investors expect. Capacity constraints, not geology, may be the real ceiling on production growth. Peter Krauth warns this structural fragility could keep prices supported longer than markets anticipate.
If you look at gold, it was almost $1 trillion. So it was 5% of the gold market on the mining side. And if you look at just the physical metal side, it's about 10%. So it takes very little to move this market, and it speaks to the limited capacity that it has when it comes to being able to get access to the physical silver. And I think that the market over the past year really has started to come to terms with the fact that this is a really small and restricted market, and yet silver is ubiquitous. I mean, silver is, after oil, the most widely used, not quantity-wise, but variety-wise, it's the most widely used commodity after oil. It has something like 10,000 applications. So it's everywhere. It's always near us. It's always within about a few feet or a yard of us, in our phones, in our laptops, in our screens, keyboards, you name it. It's everywhere in small amounts many times, and we're just finding more and more uses for it. So I think we're going to see very tight markets for a very long time to come.
A market that's small, supplying 10,000 industrial uses, is a volatility recipe hiding in plain sight. Peter Krauth notes, silver mining represents roughly 5% of gold's mining value, and only about 10% on the physical metal side, underscoring its limited scale. When demand from electronics, EVs, and solar expands simultaneously, even small capital inflows can move prices disproportionately. This helps explain why silver historically experiences sharper bull cycles than gold despite receiving less investor attention. Portfolio diversification into small commodity markets often carries asymmetric upside and risk. Peter Krauth suggests this size imbalance may define the next commodity cycle.
The silver supply from mining is providing no indication of growth. It looks like at best it will be flat or slightly grow, and yet demand remains elevated and to the tune of 10 to 15% at least above mine production. Mine and recycling production every year. So the Silver Institute thinks we're going to see ongoing supply deficits for at least the next 5 years, and we're going to see record highs. So it's going to remain a very, very interesting market.
Persistent deficits matter more than headline price predictions. Peter Krauth highlights estimates showing demand running roughly 10 to 15% above combined mine and recycled supply annually, a gap the Silver Institute expects to continue for 5 years. Flat mine production signals limited investment in new projects despite rising prices, which historically precedes long commodity upcycles. Investors should remember that sustained deficits tend to tighten inventories gradually, rather than trigger immediate spikes. This creates slow building pressure that often surprises markets later in the cycle.